Hello, I'm Stephen Lindwall. Welcome to episode 3 of this Infinite Banking Concept series. What if the structure of the financial tool mattered more than the return it promises? Jason Lowe puts it this way: cash follows the leader. When you control the system, the cash follows. In the first two episodes, we expose the problem, cash flow traps, interrupted compounding, and a constant reliance on outside capital. Now we shift to structure, because if you're going to redesign your financial system, you need the right architecture. Not all financial contracts are built the same. Some are designed for protection, some are designed for speculation, and some, when structured properly, are designed for capital control. Today, we're examining the architecture behind that structure. The infinite banking concept is built on a specific type of contract: dividend paying, participating whole life. I know it's a mouthful. Now let's contrast that. Term insurance is temporary protection. It's inexpensive, pure coverage, then it expires. Universal life blends insurance with investment components. It introduces market exposure and flexibility, but also variability. Properly structured participating whole life is different. It's built on guarantees, guaranteed cash value growth, and a guaranteed death benefit. It's contractually designed for long-term certainty. And here's the key distinction. Term protects income temporarily. Universal often chases performance. Participating whole life prioritizes stability and capitalization. If term is renting protection and universal is experimenting with performance, properly structured whole life is building infrastructure. And nobody builds a financial skyscraper on a camping tent. So infrastructure is what banks build first. They strengthen their balance sheet. Now let's introduce one of the most misunderstood mechanics. In a properly designed whole life contract, the death benefit drives the cash value. And here's the structural reason. By contract, at age 100, the cash value must equal the death benefit. That's not marketing, that's actuarial design. And actuaries are not known for exaggeration. Which means over time, the policy is engineered to mature predictably. And this is what the ascendant philosophy refers to as cash follows the leader. The larger and stronger the death benefit, the leader, the more powerful the long-term capitalization behind it. And so the strong capitalization creates stability, scale, predictability. Banks understand this instinctively. They don't start with how do we get higher returns? They start with how strong is our capital base? And when capital is strong, growth follows structure, not the other way around. Now, here's something most Canadians don't realize: ownership matters. There are stock insurance companies owned by shareholders, and there are mutual insurance companies owned by policyholders. In a stock company, shareholders expect profit first. And those incentives drive behavior. If you've ever worked in corporate, you understand this deeply. Let's reflect on this. Is your financial system working for you, or are you working for it? So, in a mutual company, policyholders share in surplus through dividends. The alignment is different. And in Canada today, Equitable Life is the remaining mutual company offering participating whole life. That matters because if you're building a long-term capital system, you want alignment between the company structure and your strategy. And this connects directly to the ascendant idea of the and asset. An asset that provides protection and capital growth, liquidity and guarantees, control and long-term efficiency. Most financial products force trade-offs. It's an or. Properly structured whole life is designed to integrate benefits, not fragment them. Before we go deeper, I want to share something personal about my own start with infinite banking. When I first applied for a policy, my application was denied. And I'll be honest, that moment hit hard. It felt like the door had closed before even I had a chance to walk through it. So I looked at plans B, plan C, plan D quickly. I pivoted. 9 days later, I had a policy for my teenage son. What felt like a setback became the first plot twist in my family banking story. That became the first building block of our financial system. 3 months after that, I had another policy, this time for my wife. She has lifelong asthma and absolutely didn't think she'd qualify either, but she did. When she got approved, she looked at me like, "Are you sure they read the right file?" So those two approvals became the foundation of everything I'm teaching you in this series. So if you're watching this thinking, "Oh, is this even possible for me?" You don't need perfect circumstances. You just need a starting point. So let me ask you two strategic questions. When building long-term wealth, do you prioritize guarantees or projections? Number two, if capital strength drives long-term control, how strong is the foundation beneath your current financial structure? Just reflect on that, because architecture determines outcome. So in closing, most people focus on performance. Very few focus on structure. But performance fluctuates. Structure endures. This structure matters because when the foundation is right, the system begins working for you instead of against you. If episode 2 exposed the leak, episode 3 here shows you the foundation. In the next episode, we'll go even deeper. How policy design determines efficiency and why most policies are built for commissions, not control. And that's where the real engineering begins. I'll see you there. Thank you.